Hello everyone, I'm Ankit and you're watching StudyIQ IAS English. In our today's video, we'll try to understand why are NRI deposits so much needed in order to save the much depreciating Indian rupee. And the reason why we have picked up this topic for our today's discussion would be very clear to you if you understand the context based on which we have discussing this article. Now you need to understand last week the Reserve Bank of India announced a special scheme. And this scheme would allow banks in India to mobilize NRI deposits denominated in dollar for a period of 3 to 5 years. Now, these NRI deposits denominated in dollars are called as foreign currency non-resident bank deposits or FCNRB deposits, right? And this scheme would continue till September 2026. In addition to that, for swapping these foreign currencies into domestic currencies and using them in Indian economy, the banks have given a concessional rate by RBI in order to protect them from what is called as an exchange risk. Right? So it is expected from this move of the RBI would bring into Indian markets as much as $50 to $70 billion. And this would save much the depreciating Indian rupee, which has been depreciating by a lot amount in the past few quarters. Now, how the scheme works, what are the technicalities behind it, you can understand from the context. This is a bit more technical topic, but I try to do my level best in order to make it as simple as possible for a common person to understand. Right? Now, the notes which I will be using for our today's session, you can also download them by going to a particular Telegram channel called as ATS Live. And while you're at it, please do not forget to subscribe to the channel also. Before understanding why do we need so much dollars to come into our economy, we need to understand the basics of our economy. And this basics is called as a concept of balance of payment. Now, balance of payment, abbreviated most commonly as BOP, it is a ledger which keeps into account of all the money going out of India and all the money flowing into Indian economy, right? This balance of payment is divided into two categories, current account and capital account. Let us first discuss what is a current account. Current account deals with all the transactions that pertains to trade in goods, trade in services, and income flowing in exchange of payment of services like payment of factors income. Right? The first part is called as balance of visibles, also called as balance of trade and more commonly referred to as merchandise trade. This balance of trade indicates how much money we are receiving and spending in as against exports and imports. So balance of trade basically means the total money flowing into India for exports minus the total money flowing out of India for imports. Right? In India, normally, as India is a net importer country of goods, our balance of trade almost invariably remains negative. Now, let us discuss what is a balance of invisibles. Balance of invisibles includes trade done in services, primary income, secondary income. What is trade in services? Suppose an Indian company performs a service in other countries, it would receive dollars. And similarly, if an Indian company would take services from a foreign company, for those services, India would pay dollars. So balance of services indicates the total exports that we have made for services minus the total imports that we have given for services. Now, what is a primary income? Primary income is an income which an Indian resident makes from abroad in exchange of factors of production like land, labor, capital as well as entrepreneurship. And secondary income is all the transfers that Indian residents get from abroad in exchange of grants, gifts, remittances, etc. Now for India, the secondary income is massively positive because you can understand India is the world's largest recipient receiving country in the world. As far as primary income of Indian residents is concerned, this primarily stays negative, while the net services is in positive because we export more services as compared to import of services. So that is for the reason the balance of invisibles in Indian economy almost remains positive. Now what about current account? Current account is the combination of balance of trade and balance of visibles. But since the balance of trade, the negative value of balance of trade is much larger than the positive value of balance of invisibles. So for India, almost all the time, barring few quarters in the past 2 decades, it has remained in deficit, and that is why you hear the word current account of Indian economy is in deficit. right? But you'd be surprised to know that our balance of payment, which is an addition of current account and capital account, it remains overwhelmingly positive. So what is leading to this positive BOP? It is our capital account. Now, capital account includes transactions done in order to fulfill foreign direct investments, foreign portfolio investments, external commercial borrowings. These are commercial borrowings done by Indian companies from abroad. Similarly, it also includes trade credits, borrowing done by Indian individual, as well as banking capital. Now, for the past 1.5 years, we have seen that outward FDI is happening from India, and foreign portfolio investors are taking their investments out of Indian market to much more advanced economies. And as a result, the positive value or the surplus of capital account, which was actually trying to compensate for the deficit of current account, has come under pressure. And therefore, the demand of our economy is to bring much more dollars in the capital account in order to compensate for the surplus of, the deficit of the current account. You need to understand, since the prices of natural gas, crude oil, etc. have risen in recent times, our current account deficit has enlarged, and that is why we need more and more dollars to come inside in our economy in order to keep the balance of payment positive and in order to prevent our foreign exchange reserves from going down. Right? And that is why this deposits from abroad can play a very important role if we have to ensure that our capital account remains in surplus. And this is the exact topic that we are discussing today. Now, what has happened in recent times, that even the deposits that are made by NRIs into India, which is the banking capital that we were discussing, they have declined. In the last financial year, it was more than $16 billion. Now they have declined to almost $14.41 billion. Now, NRI deposits into India are made into multiple different accounts. The first account is FCNRB account, which are foreign currency denominated deposits. Similarly, there are non-resident external NRI accounts, which are rupee accounts or the accounts maintained by NRIs but in Indian currency. And the third one is the non-resident ordinary account. These are accounts maintained by NRI to receive payments from their work that they are doing in India, right? But the subject matter of our today's discussion is FCNRB, because this is what we need. We need foreign dollars to come into India and they being deposited into bank accounts in FCNRB account. Now, let us get into much more detail about what are FCNRB accounts. These are fixed term bank deposits that are opened in India by non-resident Indians, people of Indian origin, as well as overseas citizens of India. Now, what is the benefit for NRIs to deposit their dollars in India? It allows them to invest in India, maintain their deposits in India without having to take care of converting their money into Indian rupees, and therefore they are not subjected to exchange rate risks which a normal account holders would be to. Right? Now, what you need to understand, the benefits include that whatever capital gains or the interest income that they make from these accounts in India, which are denominated in dollars, they do not have to pay income tax in India as long as they remain non-residents. Now, any non-resident income, a non-resident in India means a person who stays in India for less than 182 days. So they are exempted from paying any kind of taxes inside India. Now, usually what does happen, that Indian banks on FCNRB deposits, they offer rates which are very similar to the rates offered abroad based on international benchmarks. And these rates, you can understand, are lesser than the fixed deposit rates that are offered by Indian banks to Indian depositors. Now, based on this understanding, why or what is an incentive for NRI here to invest in India, we'll discuss about that. But first, let us try to understand how would bank exchange this money and utilize it in Indian economy. Now, you need to understand, whenever banks receive deposits denominated in foreign currencies like dollars, like pound, like yen, they can't straight away use it to give loans to Indian people, right? Now, to use these foreign deposits and extend loans from these foreign deposits, banks needs to exchange these foreign currencies into Indian rupee, and to return it to the original deposit holders, bank need to exchange Indian rupees again back to the foreign currencies. So for that, RBI offers a facility of swap to Indian banks. Right now, here RBI has offered some concession to Indian banks so that they are protected against what is called as the depreciation of Indian rupee. RBI said that you can sell us US dollars in multiple chunks of $1 million each and simultaneously agree with us to buy the same number of dollars at the end of a swap period. So this swap period, you can understand, is a two types of transaction. First, dollar into rupees, and after maturity, rupees get converted into dollars. So RBI stated that when you receive dollars and you have to convert it into Indian rupees, you will provide these dollars to us at a rate which is fixed by the FBIL reference rate. What is an FBIL reference rate? FBIL means Financial Benchmarks India Private Limited. It is a company which basically publishes multiple benchmark interest rates and foreign exchange reference rates which are used by financial institutions in order to exchange their foreign currencies with Indian currencies. So this is the first leg of the transaction, which includes conversion of foreign currencies into Indian rupees, and they will be used by banks to extend loans to Indian customers. Now, for this swap to complete, you need to understand the second leg of the transaction should also happen. And this second leg of transaction, RBI states that whenever it comes for you to exchange your rupees back to foreign currencies, I will take those for rupees in exchange for foreign currencies at the rate for which you have paid in the first leg of transaction. So basically means that even if the rupee depreciates in between these two legs of transactions, the banks won't have to suffer a loss, and this loss in a way would be absorbed by the RBI. So these are the one benefits for the banks. Second benefits for the bank, that if an Indian depositor like you and I would make a deposit in Indian banks, banks are required to fulfill cash reserve ratio and statutory liquidity ratio requirements before extending our deposits in form of loans, right? But the RBI stated for every FCNRB deposits, the banks need not maintain or are done away from keeping CRR SLR. So this is an added advantage of the bank. So every dollar that the banks receive from FCNR deposit, theoretically, it can be extended as loans to customers after conversion into Indian rupee. Right? So now we have understood why these dollars are important for Indian economy, and now we have understood how these dollars would be exchanged into rupee and again back to foreign currencies and without letting the banks face any loss. But now let us try to understand what's in it for NRI. Why would they try to invest their hard-earned money into Indian banks? Now, there is a very good reason behind it. The reason is that from now on, the Indian banks, most importantly banks like HDFC and Yes Bank, they are saying that they are going to offer much higher interest rates on these deposits, as much as 6 to 6.8%, which is about 2% more than what they were offering before. Why are they offering higher returns? Because there they do not have to face exchange rate risk. Now, how would NRI make money here? Let us understand this. Now, normally, if an NRI deposits their dollars into India, they would get 6 to 6.6% of return on an average. And if they would have made these same deposits in an American bank, American banks would have paid them about 4.2 to 4.3% interest rate. So NRIs are earning more interest rates in India on the same deposits as compared to the deposits made in American banks. But this is not the only thing. NRIs can get their returns multiple times by using a concept which is called as a leverage. Now, leverage in financial terms actually means that when you borrow money and you amplify this borrow money by placing it somewhere which gives you a higher return. So how would NRI benefit from this concept of leverage? Let us understand this with the help of an infographic. Now, normally, if you were an NRI and if you bring $1 million and keep them in FCNRB deposit accounts in Indian banks on an average, let us assume for simplicity purposes, would give you a 6% interest rate. So if you deposit this money for 3 years, you are about to make 190,000 US dollars in form of interest. So this is a normal return that an NRI would get, which any day would be higher than a return that they would get from US banks. But this is not it. What NRIs can alternatively do, that once they deposit this $1 million in FCNRB accounts in Indian banks would issue them a letter of credit. This letter of credit is basically an assurance that an Indian banks would give to another bank from where NRIs would go and borrow further money, that once these deposits mature, you would get your money back. And NRIs can use these letter of credit and get further loans from US banks at a cheaper interest rate. So suppose an NRI deposits $1 million in Indian bank and gets a letter of credit. Taking this letter of credit, he goes to an American bank and borrows $10 million, for which he has to pay 4.5% interest rate. He would take these $10 million from US, come to India and deposit it again in his FCNRB account. So how much is the total amount of money he has deposited in FCNRB account? $1 million originally. In addition to that, he has brought $10 million more. So total deposits amounts to $11 million. How much interest rate was Indian banks offering him? He was offered 6% interest rate for 3 years. So after 3 years, his deposit matures and his $11 million after adding with interest amount increases to $13.1 million. Now, he has taken a loan from American bank worth $10 million, for which he has to pay 4.5% interest rate. So after 3 years, he has to return $11.4 million to American banks. So he has gotten $13.1 million from Indian banks and he has to deposit $11.4 million to Indian banks, which means this NRI is making a profit of $1.7 million from his original just $1 million investment, which means a compound annual growth rate of returns for this NRI becomes almost 20%, which is as good as you investing in a very healthy stock market, right? So this is it for NRI. Why would they bring so much money into India? So NRI benefits because he earns money. American banks benefit because they are giving large chunk of loans and receiving interest income, and invariably both Indian banks as well as Indian economy benefits because we are getting much needed flows of American dollars, foreign currencies into India, and this huge inflow of foreign currencies into India would save our rupee from depreciation. Why does rupee depreciate? Rupee depreciates because the supply of dollars in Indian economy is well behind the demand of dollars in the economy. So we are trying to balance this demand and supply mismatch by bringing more dollars into India. Right? So this was the chunk of our today's discussion. Now, before we move forward and solve a UPSC level question based on our today's discussion, there is a very important announcement. The topic that we just covered, I've taken it from current affairs. But in order to make you understand, I've infused basic concepts of economy like balance of payments, right? So I hope this kind of a discussion enriches your knowledge and also makes you very solid when it comes to understanding the basics of the economy. Similar kind of a class or similar kind of an approach we also take when we study students for UPSC for all the subjects, not just economy, and all of them are taken in GS P2I foundation batches. These foundation batches are offered in English language for students looking to prepare in 2027 as well as 2028. The best part about our batches that we offer smart model, that we offer structured classes with mentorship, which helps you assess, which helps you revise and give tests, and ultimately your dream of getting selected into UPSC, into All India services will be fulfilled. Now, if you take admission, you are going to get 50% off on all the courses. And in addition to that, if you apply this code ATS Live, you're going to get even more discounts. So please remember, this is a limited time offer. And if you take admissions after the end of this offer, you end up paying much more than the present amount, right? Now, before winding up our today's discussion, this is the question that I want you to solve. This is very basics with respect to the capital account of balance of payments, which we have covered today, by the way. From 2013, this question is. Do let me know the correct answer to this practice question. And if you want to download the notes, this is where you'd find it. The Telegram channel is called as ATS Live. So this is all from my side for today. Please have a very good day. We'll see each other again quite soon.